Hello, hello, hello. What's going on, everybody? Welcome to a capital hungry fundamental and technical analysis webinar on gold. It is currently roughly 4:10 p.m. Eastern, Monday, April 10th. This is a live stream, but anybody can re-watch it afterwards when it's saved, and you can take your notes, follow the analysis. Of course, do your own due diligence and analysis as well, and see if you can come to the same conclusion points as me once I explain my thought process. But anyways, this is going to be a new style of presenting capital hungry analysis, content, and information, as I was getting a lot of complaints from people that the webinars I do are too long. People are saying they're too long. Like, damn, your market update webinar, it's like 45 minutes, an hour and a half, 2 hours long. It's way too long for my short attention span, low IQ, monkey brain. Jeeve, can you please help me out? And I was like, all right, fine. I'm going to just break up the market update webinar through the entirety of the week and do one pair a day. So today we're starting out with gold, and we're just going to be jumping right into it. Fundamental and technical breakdown, review from higher time frames to intraday time frames, what economic events we have on the table, then of course trade ideas for potential day trades and scalps depending on your trading style. So right now you can see we're looking at gold on the daily time frame, and we're going to be looking at some very key fundamental factors and important data set information alongside key price points of interest. So you can see here we saw gold have this explosion all the way into historical highs, plus to $2,000 plus an ounce there, obviously during this period of time, which was of course seeing a lot more recessionary scare risks, right? So this was COVID lockdowns time. This was Russia invade Ukraine. This was weaker US data, banking collapses, recession scares, right? We had declining labor market report in the US, SVB collapse, and so forth, right? Now, this is all fine and dandy that we had more demand into gold as market risks were, of course, coming to the table with the banking sector collapses, economic data declining, and so forth. But we have to look at very key price points of interest and measure market impact based on these fundamental catalysts. We can clearly assess that around $2,000 an ounce on gold is a very, very key higher time frame institutional price point. And we can also assess that anytime we have revisited these price points and potentially broken higher, it was due to major fundamental catalysts in play. You can see here it was of course the COVID lockdowns and money pumping phase when the feds were increasing the money supply. Here it was Russia invading Ukraine, and here so far it was that bad economic data, but we're going to talk about something very important that followed afterwards, right? So here you can see marked out in red key institutional, and then here highlighted in white is just to understand that major fundamental catalysts led to breaks above this price, and if no new fear, uncertainty, and doubt events, very short-lived. Here you are only above the 2000s and $2,005 an ounce for about a week. Here during the Russia invasion Ukraine, you are only above $2,000 an ounce for under a week. Here, we were really only above $2,000 for about a week, right? So this tells us very, very important information. It tells us, one, that we've seen demand increase in gold, obviously when there's major fear, uncertainty, and doubt catalysts, and you also see major buy-side liquidity entering usually at very similar price points as well. Here, prior to the Russia invasion of Ukraine, we were primarily ranging, then started to get the explosion in price of gold starting to trend a lot higher into these historical highs, just a bit above the 1800s. We can see the same thing here before the banking sector collapses started to take place. You can see the same thing here as well, where you were just primarily ranging, just going slowly upwards in price, then had a huge explosion during the COVID fear, lockdowns, and money pumping phase, right? So we can also assess that on the flip side, this is a very key important institutional price around 2000s, where the majority of fear, uncertainty, and doubt at the time here gets priced in. And if you do not have any new events bringing fear, uncertainty, and doubt, you can see very large corrections or bearish waves take place. So now we have to understand something. Gold has exploded from the 1800s all the way to the historical highs around the 2000s due to these various fundamental catalysts. But these fundamental catalysts have found solutions for the various issues, such as the SVB collapse, Credit Suisse issue, and so forth. And a lot of the bad economic data, as well as these events, have been priced in. We also saw something very, very strategic and very convenient towards the end of last week. For those of you who didn't know, last week, non-farm payroll, U.S. labor market reporting from the unemployment rate and wages data came out optimistic, but it was during the bank holiday of Good Friday, where from our retail trading perspective, commodity markets were closed. So gold technically closed the week last week below the 2000s because we saw the gap down this week on Sunday open due to the NFP movement, of course, being priced in and us observing that as a gap. You can see at the end of last week on Friday, the labor market reporting was very optimistic. It canceled out a lot of the negative data we had in the previous first half of the week, such as JOLTS jobs openings, ADP private sector reporting, and it still showed the labor market was tight and started to take away from recessionary scares. This led to gold essentially and technically closing back below that $2,000 ounce price point, right? And now, I'm not saying gold is going to be bearish coming all the way back down to the 1600s, but you can see here whether gold is bearish or whether it's bullish, it's very common on its intraday movement and weekly movement to have very aggressive waves in changes in price. You can see that here once the COVID fear, uncertainty, and doubt was priced in and the market started to correct that movement and the drastic waves in price as we had bears take over. You can see that here as we were starting to make our way to the upside prior to the explosion in price with Russia invading Ukraine. You can see that here on the downside when we had the dollar domination phase and the bears took over, very aggressive waves in price. And there's more than likely a high probability that we're going to be seeing that here as well before we continue bullish and have any fundamental catalysts for us to be really remaining and holding above $2,000 an ounce. Because you can take this fundamental information and you can ask yourself questions. Let's look at this logically. Something as large as COVID, global pandemic, and economies being locked down and economic activity being stagnant, as well as, of course, the money printing that went on by the central banks, something that large of a fundamental catalyst led to gold exploding from these lower prices all the way to $2,060 an ounce, but failed to hold above there and still ended up just pricing in that move and following this large correction. Then obviously price stabilized. We had the next major fear, uncertainty, and doubt catalyst come into play, which was Russia invading Ukraine. Something as large of a catalyst as military tensions escalating and Russia invading Ukraine was enough to see us see demand increase in gold and buyers explode with value going from 1800 to 2000, but again still failed to maintain holding above 2000s and ended up having this large correction as the majority of events with Russia invading Ukraine were priced in, and then the central bank Federal Reserve started their most aggressive rate hike cycle seen in history. Here, something as large as seeing some banks starting to fail, such as SVB collapse and some bad economic data, one report after another, yes, it was feeding into recession scares, but that move has been priced in with us going from the 1800s to 2030 an ounce. You can see with NFP being optimistic at the end of last week, we still failed to hold above the 2000s and closing back below potentially previous key intraday highs. You have to ask yourself some questions here. If in the near term, we are of course scalpers, day traders, holding trades for multiple sessions or a couple of days, or scalping for just minutes or up to hours, right? We have to ask ourselves some questions here. What if we don't get any new fear, uncertainty, and doubt catalysts, if we don't get any actual military escalations to impact the markets, like China actually invading Ukraine, if we don't get continued stacking bad economic data reports, if we don't get any new banks starting to fail and more financial sector uncertainty, right, then it would not be out of the ordinary for gold to have a larger correction wave and potentially be seeing a correction into the 1920s and 1900s before buyers come back into the market. Because let me discuss two things here. One, on the higher time frame and macro perspective, the bull case for gold is starting to get a lot more prominent and a lot more evident. There are more macro reasons stacking up for gold to be bullish, like these military tensions starting to bubble up, all of the cracks in the financial sector starting to be exposed with banks starting to fall out, all of the recessionary scares developing with economic data weakening. But as a day trader and scalper, that doesn't mean you can just blindly be jumping into buys, because the way gold, this precious metal individual asset class, behaves on a day-to-day or weekly perspective is you have these huge, monstrous, aggressive waves and price changes as events get priced in. You have order flow and price setups for at better price points of interest to continue the trend. So if COVID lockdowns was not enough for us to maintain above the 2000s, if Russia invading Ukraine was not enough to maintain holding price above the 2000s and buyers pooling in more liquidity from these higher historical high prices, if these banks collapsing and bad economic data so far wasn't enough to break us above, then clearly we need new fundamental catalysts to be trading above there. What could those fundamental catalysts potentially be? Hold above 2000's higher time frame. Continued declining economic data reports feeding into the recession scare narrative. More banking fails. New banks that we haven't seen fail already yet. Like, we can't just see SVB issues come back to the table. Global war escalations. US dollar well below 101 in terms of dollar index. Or any new fear, uncertainty, or doubt catalyst, right? All of these events that have led from 1800s to 2000s, like the bad data reports at that time, the SVB collapse, the Credit Suisse collapse, the bad factory orders and PMI data, all of that has been priced in. Just like, for example, Russia is still actively invading Ukraine, but that's not holding any more market weight. The markets move ahead of the curve, always trying to have an information advantage and always trying to have an edge, moving on anticipation. That's where the pricing in concept comes from, right? So you can see Russia invading Ukraine was priced in here. COVID lockdowns and fear was priced in here. The banking sector collapses and bad recessionary data we had so far has been priced in here. And at the end of last week, we actually had very optimistic data. Now, look at this. The same time gold is potentially holding above this very key liquidity zone and could potentially give us a pullback wave to retest higher time frame bullish structure, right? Coming into the 1910s, 1920s before buyers come back into the market potentially, and us adapting to this downside wave if we don't get any new fear, uncertainty, or doubt. The same time we're getting this rejection on gold, dollar individually here, when you're looking at market sentiment and your intermarket correlations, is giving us a beautiful bounce from that key weekly level I've been highlighting to everybody at around 102, 101.5, right? So that optimistic labor market reporting is still having dollar hold above these key historical high prices, 50% correction of the dollar domination run, and starting to see more demand and dollar stabilize at these better price points of interest as well. So when we're looking at correlations, we don't really have much in focus the first half of the week. The next important report is going to be US CPI midweek, where if inflation is still high and showing that increase or still relatively elevated, all that's going to do is show that the Feds need to continue tightening financial conditions. And if dollar can't break below 102, dollar's going to start trending bullish back to 104 and this double bottom leg around 105. If dollar can't trade back below 101.5 and 102, and gold can't break back above 2005 area, right? This shows me a lot of the fear, uncertainty, and doubt regarding recession scares short term have been priced in. What else is showing me that fear, uncertainty, and doubt short term has been priced in is Japanese yen turning back bearish as a safe haven currency here. We can see yen was bullish during the banking sector fails and bad data, but it's turning back bearish here as a lot of the fear, uncertainty, and doubt has been priced in. Bank of Japan further cementing their dovish monetary policy, and a lot of the recessionary scares have passed and priced in so far as well. So if we don't get any new military war tension escalations, if we don't get any new banking failures, if we don't get any new continued stacking bad economic data reports, yen's going to continue bearish following its central bank monetary policy, and gold more than likely is going to continue to trade below that price point around the 2000s and end up having a corrective wave down to the 1900s before seeing buyers come back into the market, right? So now, before we jump into the trade ideas here on gold, some key things we have to understand and just review there. If we don't see any new fear, uncertainty, and doubt based on economic events such as data reports, or of course reactive events such as news headlines, there's a less probable chance gold will be trading above the 2000s and holding above there. If we have gold holding on the intraday below 2005 here, not correcting this downside move, and we see dollar stabilizing above 102, plus we still have a high CPI report, it would not be out of the ordinary for gold to enter a corrective wave down to the potentially 1900s where we would be adapting to these sells. And you can see very common whether gold is trending bullish or bearish to have these corrective large waves in price changes. Right? Now, in terms of economic data, we don't really have anything going on tomorrow with the US economic data, and a lot of the major fundamental events have been priced in. So we're just going based on market sentiment and order flow. As long as gold is holding below roughly 2005 area and dollars holding above 102 key price point, that shows me a lot of the recessionary scares have been priced in so far. The macro central bank policy still holding more weight. We can see a similar repetition of buyers liquidating positions from these highs and not seeing gold completely come all the way back down to 1800s, but easily seeing a bearish corrective leg to revisit key bullish market structure points into the 1910s and 1900s here. Right? So now on the intraday, when we're breaking down price action, we can see the fear, uncertainty, and doubt that came with bad economic data was priced in. We started to correct the move, then the optimistic NFP led to a full correction of it. If we maintain holding below these previous intraday highs and cannot break back above these price points and do not get any new fear, uncertainty, and doubt, as long as dollar holds above 102, then I'm going to start to expect to see legs down, minimum back down into the 1950s, just on an intraday perspective. I personally cannot see any gold buys unless we're trading well back above the 2020s and 2030s, and we would need a fundamental catalyst for that as well. So now, bringing all that information together to the table, these are the trade ideas we have and the trade ideas that I'm looking for. These are just higher time frame key levels and some key intraday zones highlighted as well. And we're just going to label the chart. Okay, so the majority of this movement was still fear, uncertainty, and doubt, holding weight from the banking sector fallouts and bad economic data stacking up from bad US PMI figures, factory orders data, ADP private sector reporting, and so forth. You can see based on order flow, we didn't have enough liquidity to be trading above this 2028 key level price point, then started to cancel out some of the upside movement, with majority of the upside movement being canceled out due to optimistic NFP. Now, this is very important because this led to us seeing a higher chance of repetition to what we've seen during the COVID and Russia events when we came to these similar price points and they got priced in. We can anticipate that if we don't get any new fear, uncertainty, and doubt, if dollar stays stabilized above 102, that it would not be out of the ordinary for gold to see larger corrective waves and potential bears in play in the short term and intraday. If we get pullbacks to 2005, 1997, I'd be looking for sells. Breaks below 1988 and 1980s, I'd be looking for sells. Confirms for that are Japanese yen remaining relatively flat or bearish, highlighting no new market fear and not seeing any risk hedging into the safe haven asset classes. Dollar holding above 102, a higher CPI report, no new fear, uncertainty, or doubt events, and following this formation in price. From where we are currently sitting and current fundamentals, I can only see buys above the 2010s with either continued declining economic data reports or new fear, uncertainty, and doubt events that haven't been priced in already. A different bank starting to fail that's a major bank in a large region, or military escalations that are actually having market impact, not just noise and political disputes so far. Okay? Keep in mind, we're still early into the new business quarter of Q2. A lot of the major events so far have been priced in. We're seeing a slight slowdown in volume and volatility. Some of the more important economic data is in the second half of this week with US inflation figures. You guys can always rewatch this as you wish. It's going to be saved and uploaded, and I'll see all of you next time.